Use these two strategies to build insane levels of wealth. So the second secret that banks don't want you to know is how to use a master limit for debt recycling. Now, what's debt recycling? Well, before we come to this example, check out this cool little explainer video.
Debt recycling in action. Debt recycling is the process of replacing mortgage debt or bad debt with investment debt, which is known as good debt. This is how debt recycling worked for one couple. Mark and Jane have built up considerable equity in their home and, upon advice from their financial planner, decided to make the equity work harder for them. The couple currently owes $240,000 on their home, which is valued at $400,000. Their licensed planner recommends Mark and Jane implement a debt recycling strategy, refinancing their current loan to give them a $300,000 loan limit. This releases $60,000 of available equity for investment. Mark and Jane's planner recommends they invest their $60,000 equity into a portfolio of managed investments specifically chosen for income potential. After 1 year, their portfolio has grown in value to $65,000 and yielded an income of $4,000, which is used to pay the interest on the investment loan. Any surplus is used to reduce their mortgage further. After regular loan repayments, their mortgage balance is $230,000 after the first year. The couple then draw the extra $10,000 in equity to make an additional contribution to their investment portfolio. This process is repeated each year until their mortgage is extinguished.
So using this example, let's say you've got a property that's worth $1 million. Well, you can get a master limit of $800,000 or 80% of the value of the property. Now, let's say you've got a $500,000 home loan that you owe with XYZ Bank. Now, you refinance that home loan, but you've got a master limit of $800,000. So that gives you an extra $300,000 to use. Now, we set this up in a separate split, usually held in a line of credit, which you can see here. So you have, all of a sudden, you've got a master limit set up now. You've got your home loan or non-deductible debt or bad debt, and you have your deductible line of credit. So this is your investment debt. So we're going to use this $300,000 to invest. Now you can invest it in whatever you and your financial planner, financial advisor come up with that suits your needs. So in year 2, what you do is you have all the either dividend income, your PAYG income, or rental income, whatever, and it goes into the non-deductible home loan. And so as that goes down, you then increase the deductible line of credit because you've still got that master limit at $800,000. So everything's going into the non-deductible home loan, but then you can draw out from the line of credit to buy more investments. Same thing again, the next year. All that extra investment income goes into the non-deductible home loan. So the non-deductible home loan is going down each and every year. And at the same time, you're increasing that deductible line of credit to use for investment purposes. And the great thing is with the master limit is that you've got that limit for $800,000. There's no need for credit approval each year. You can change the loan structure to meet your needs at no cost. If you actually needed to create a new home loan split or a new home loan account, you can do so. You can have up to 10 different loan accounts or splits under the master limit product. But for this example, we've just got the two, the non-deductible home loan and the deductible line of credit. So that's the investment and the non-investment debt. Year 4, so now you can see that you're really starting to pay down that home loan, that non-deductible home loan, and at the same time increasing that line of credit. So you're investing more. So you're paying off your home loan while using that master limit to buy more investments and to grow your portfolio. Year 5, you can see the numbers there. So in 5 years, the non-deductible home loan or bad debt goes from $500,000 to $331,000, while the deductible line of credit or good debt goes from $300,000 to $468,000. Now, that's not taking into account your investment returns, any capital growth, or whether your portfolio goes up or down, sideways, whatever. Now, this is pretty powerful when you use an income strategy. So if you're getting dividends or if you know how to write covered calls to generate premiums on your portfolio, this can be very, very powerful, and you can really pay down that home loan even faster. And in 10 years, the non-deductible home loan or bad debt is now $0, while the deductible line of credit or good debt goes to $800,000. So you've now used up that master limit, and you've got $800,000 worth of deductible investment debt, while you've paid down your non-deductible home loan debt. And hopefully in a 10-year period, your investments have grown and you've got a large investment portfolio generating really, really good investment income. And this is the secret. The second secret that the banks don't want you to know is how to use this product. Now, in Australia, there's only a couple of lenders who provide this product. If you want to know more about the master limit and debt recycling, go to our website, firstchoicefinancegroup.com.au. We're a mortgage broking business in Australia, and you can download my ebook, Ditch the Debt, 7 Steps to Paying Off Your Mortgage in 10 Years or Less. Or you can contact us by phone on 1300 123 036. That's 1300 123 036. Or send me an email at admin@firstchoicefinancegroup.com.au.
We're in a debt of a 30-year home loan. We had a couple of car loans, a boat loan. We just felt like we were getting nowhere. We just wanted to create a financial road plan that was tailored to suit us individually. We want to get rid of all the debt, pay off the house as soon as possible and start saving for retirement. The best thing is that First Choice Finance Group don't charge a fee, and they've become our personal finance coaches. Yeah, our financial future feels very secure. We're well on the road to paying the house off early. The house is the only debt we've got. We own the cars and the boat. And we're also putting a big part of our super away and planning for an early retirement.
We're on track to pay off our home loan by the time we're 55 at the latest. As we both continue to receive pay rises throughout our career, we'll continue to save, also making a nice little nest egg for us when we retire. It's the best decision that we could have made. Not only was their service free, also we felt that they had our best interest at heart, and it's the best decision that we've ever made. We're happier knowing that we're on the right track to retire at a nice early age and also have a nice little fund sitting there. Anyone who wants to work towards a debt-free life and early retirement, we definitely recommend giving First Choice Finance a call.
So paying your home loan is like buying coffee every day. You get your drink, but that's it. Where debt recycling is like using a loyalty card. Now, every repayment gets you closer to something extra, like a growing investment portfolio. It's the same spend, just smarter, plus you get the tax benefits. Now we mix that strategy, debt recycling, with renting out stocks or covered calls. And we've done this video, how to earn 30% per annum renting stocks, just what I do. And we've done this video, become your own central bank. And here I just want to share a little clip of how we rent out stocks. And I'll share an example in this video of how we rent out stocks. And combining these two strategies is how we create insane levels of wealth. So far in this video, we've looked at how Warren Buffett predominantly uses naked puts to generate cash flow or passive income or profits that he uses to reinvest into buying more stock or building up his cash position. However, I don't want to focus too much on that. It's probably a little bit more sophisticated than the covered call option strategy, and that's simply because you need to have the skills to be able to value stocks. One of the risks is if you sell a naked put on a stock and it does go to zero and you've offered to buy it at $35, well, guess what? You've got to buy it at $35, even though that stock has now gone to zero. Very rarely does that happen, but you do need a little bit of sophistication, a little bit of experience to do that. But a lot of you will own shares, especially blue chip shares, in maybe a self-managed super fund or outside, just in a general portfolio. In Australia, maybe you've got the banks, BHP, Rio Tinto, Telstra, a lot of the blue chip stocks, and you might be getting a 3, 4, or 5 or 6% dividend yield depending on which stock that you own. Now, a covered call can generate even more profit, even more passive income, even more cash flow than just the dividend. And since you've already owned the stock, well, this is a strategy that you can do. So a covered call option is a two-part trade. First, you buy the shares and you sell a call option. A call option is a financial contract between two parties, the buyer and the seller. Every option contract has both a taker, or the buyer, and predominantly everyone, most mums and dads or small traders, are buyers because they see the upside potential. However, you need to look at what the potential to profit is. So they look at the profit potential, not the potential to profit. And I'll speak a little bit more about that at the end. And a rider, or the seller. As an option seller, you can generate monthly income. What is a call option? An option is a contract which gives the buyer the right, but not the obligation, to buy shares at a specified price on or before a specified date. The seller, or the rider, is obliged to sell the shares at the agreed price and date. How do you earn income? Well, first you buy the shares which you own and write a contract to sell those shares at a certain price by a certain date. And the buyer, or the taker, pays you a premium for the contract. So let's say that you bought 5,000 shares of Qantas at $1.14 per share. Now, this is going back 2014 when this was the case. Qantas is now around that $5 mark, keeps going a bit above and a bit below. But let's say you bought 5,000 shares of Qantas at $1.14 per share, and you sell 50 call options at a strike price of $1.15. So we'd call this at the money, because you bought it at $1.14, you've agreed to sell it at $1.15. So there's a thing called at the money, out of the money, and in the money. I used to sell a lot of at the money or even in the money for big premiums. Nowadays, I buy value stocks and I write out of the money call options and generate both premium, but also a lot of capital gain. Now, the contract expires in less than a month. So I always do short-term options. When I'm selling options, I want the time period to be as short as possible, because that gives the buyer of the option less time to be right. If I'm selling longer-term options, I'm giving the buyer more chance to be right, especially when it comes to calls. Puts, that's another story. Now, you earn 6 cents a share, which is $234, or a 4.11% return. 50,000 shares, and you earn $2,340. So what does this mean to you? By selling the call option and getting paid for it, you're obliged to sell the 5,000 Qantas shares at the strike price of $1.15 to the buyer any time between now and the date of expiry, if you're called away by the buyer. So sometimes it can go above the strike price for a short period of time. However, you're not called away by the buyer. and then the price of the share falls back below that strike price. But you also got to take into account the strike price plus the premium paid by the buyer before the buyer of the option is profitable. So you get to keep you get your investment back and keep the premium, or you keep the shares and keep the premium, either or. So there's two possible outcomes with covered calls. If Qantas is below the strike price of $1.15, the option expires worthless and you keep the shares and the premium. And then guess what? The following month, you write another covered call. If Qantas is above the strike price of $1.15, you sell your shares at $1.15, make a small profit, and keep the premium. So what does this all mean? If you buy or own shares, you can write call options each month and earn income. These are called buy rights. Shares generate income. And can I tell you, this is my bread and butter trade. This I just love. I just literally month after month, year after year, it's just so easy to print currency. I hate using the word money. Currency, which I then use to buy more shares or more gold and silver. Buying shares and writing seller calls outperforms owning shares alone. So you can see here, buy right strategy, a growth of a $10,000 initial investment. So if you were to use the buy right strategy, you outperform because you're generating more income, reinvesting that to buy more stock. Following month, writing another cover call, probably getting a little bit more premium because now you've got more shares, so you can write some more contracts, and then so forth and so forth and so forth. So here's an example of a trading plan of $100,000. Now, this is an old trading plan, so you can see this is an old presentation that I've done. Probably should update it, but anyway. So we've got, what do we got there? We've got DJs, Fortescue Metals, Fairfax, Newcrest Mining, and Qantas. And you can see the number of shares that I own, the option contract. So there's 100 shares to one option contract. There's the share price. That's what it costs me. Then the equity or the brokerage, the strike price, the premium that I received. So you can see the difference between the share price and the strike price. So some are at the money, some are out of the money, and none are in the money. The brokerage, and then you can see the net profit not exercised, and you can see the return there. So 2.67%, 3.15, 4.62, 4.9, 3.3, and then you can see exercised. So if I was exercised plus a brokerage. So if you look right down the bottom, so a total portfolio of $100,000 or just over, I made $3,702.50, which is a 3.7% return. If I was exercised, that would be a $4,417 profit or a 4.41% return. So you can see how easy it is if you have a portfolio of blue chip stocks where you can sell options or sell calls to generate cash flow. Now, this is the example of the $100,000 trading before on the last slide. So $100,000 or just over $100,000, say 30 days, not exercised, got a 3.7% for the month or $3,700. If I was exercised, well, you make a little bit more money. So you can see that there. Now, let me throw this out there. Let's say that you had a particular home loan product, a master limit product, where you can actually pay your home loan off in under 10 years, while at the same time building wealth for the future. And I'll do a video after this explaining this master limit product. There's only a couple of banks in Australia that offer this particular product. But let's say you had this product and you were able to borrow an extra $100,000. So you had your initial $100,000 or $193, and you're able to borrow another $100,000 using this master limit product. It's a home loan product. Now, the interest rate on the investment portion of that master limit product is 3.49%. Now, that product is not a margin product. So if the stock does fall, you do not get a margin call on this. And that's the other benefit of a master limit product on your home loan. So the interest rate is 3.49%. So the interest is $290.83 per month. Now we got those returns, 3.7 and 4.4. However, now because of that extra leverage, by not being exercised, you've generated just over $7,400 for the month. If you were exercised, you've generated over $8,800 for the month. Now, when you take out your interest that you just paid for the month, your net profit is just over $7,100 for the month, or just over $8,500 for the month. So you can see how powerful it is using a little bit of leverage, but using a smart product called the master limit product on your home loan, which actually what you do then is you take that income down the bottom there, that $7,000 or $8,000, whichever happened for the month, and you pump that through your home loan to pay down your home loan, and then you basically debt recycle it through the investment side of it and buy more assets or buy more stock, write even more covered calls, make even more premium. So you can see it's very, very powerful. So on a $200,000 portfolio, you can actually see the type of monthly income that you can generate. So a covered call option is when you own the shares and sell someone the choice or option to buy your shares at a price you both agree on or before an agreed date. Before you enter into this contract, you need to know a few important things like share price, contract size, strike price, premium, and how much you make, both exercise or not exercised. However, I definitely recommend you do a little bit more research. And these are some of my favorite books that I would recommend. Funny enough, the book on the right, The Lazy Trader, down the bottom, Neil Godwin. Neil is actually a client of mine. And he's been a full-time investor writing cover calls since the early 1990s. So he's practically been retired, traveled around the world for 12 months, lives a very, very good lifestyle doing this. And he's a client of mine. He was the second person to introduce me to this a long, long time ago. Get Rich with Options at the top right is one of the best options books, one of the most simple option books, and it actually goes through a few different option strategies, but it also gives you the stats. So when I was saying before about people like to buy options because of the profit potential, in this book it lays out the stats about the potential to profit. What I mean by that is it's something like 94 and 96%, the numbers are in the book, of people that buy options lose money. So those option premiums expire worthless. So on the other side of it, those that are selling options are winning. They're taking lots of little wins along the way. The Intelligent Option Investor, very good book. On the left, covered calls and leaps. Leap options is another strategy that I do, which I actually learnt from Joel Greenblatt in the book next to it, You Can Be a Stock Market Genius. And there's a couple of young fellas in the movie The Big Short that also picked up that book and learnt that strategy of leaps, and that's how they generated a lot of their wealth. Naked Puts down the bottom left, if you want to learn more about how Warren Buffett uses, in particular, naked puts to generate that premium. You can see I'm a big Joel Greenblatt fan, my favorite all-time investor. I've put his 3 books up there, The Big Secret for the small investor, You Can Be a Stock Market Genius, and The Little Book That Beats the Market. And then a couple of Buffett type books there, Value Investing and Buffett Beyond Value. So if you want some more information on covered call trading, definitely get those books. However, feel free to send me an email at jsinvest@firstchoicefinancegroup.com.au, and I'll personally email you a link with a whole bunch of information. Also, the ASX options course, which you can do for free. I highly recommend it. But I'll give you some wonderful little books to so that you can do some further education on covered call trading in particular. So I'll send you an options pack with presentations, ebooks, and templates, the ASX options course. And I also recommend for my American friends or even my Australian friends is if you listen to podcasts, check out Tyrone Jackson's Trading Stocks Made Easy podcast. So anyway, guys, if you like this video, hit the like button. Look, share the channel with your friends if you think I provide good content here. Love to get all this content out to more people. So yeah, please share it. Love to see your thoughts and opinions in the comments below. Otherwise, I'll see you again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.